Welcome to Slackin' Off with Brady Slack.
Welcome to another episode of Slackin' Off. I'm your host, Brady Slack. Every so often, you guys get the benefit of just me, and today's one of those days. For a couple reasons. The first reason being last week I was in Dallas at a quarterly meetup for a group that I'm a part of. And there was about 120 business owners, entrepreneurs, investors in this quarterly meetup, all of whom own businesses that are doing multiple 6 or 7, maybe even some 8-figure business owners in the room. And this group is very tactical. Lots of home service business owners, lots of real estate, a couple other financial professionals. And the idea of this group is that, we're always trying to find ways to get better. We're always trying to network. And this quarterly meetup was really interesting. We talked a lot about technical and financial training tips for your business. Now, this was the first meetup that I'd been to in this group. And I guess my naivety, I thought going into it, I knew we were going to, they asked us to print off your P&Ls and bring those in. We were going to go over those. We were going to go over budgeting. We were going to go over profit and loss statements, balance sheets. So I take those things for granted. I look at those things day in and day out, not only for myself and the businesses that I'm a part of, but for the clients that we have and their businesses. So maybe I take things for granted. So I kind of assumed walking into this meetup that, that these individuals whose businesses are doing 6. I mean, it costs a lot to be in this mastermind. So I guess I just assumed that they would have some of those things figured out. Again, there was 100 to 120 people. And the question was asked, how many of you guys have a P&L that is accurate and up to date? And besides the 5 or 6 financial professionals of us that were in the room, there was maybe only like 3 or 4 other people that stood up. Said, yeah, I get monthly reports. I look at my financial statements on a weekly basis. And most everyone else said, yeah, I kind of run my business based on what cash I have in the bank account. So that was a longer version of the story to say, okay, there's things that maybe I take for granted that I want to simplify and dumb down a little bit. Second reason, there's an individual on Instagram. If you're not following him, you should. It's Edward Verified on Instagram. I can put his. I'm actually going to look for it because I want to make sure that you guys know who it is. But it's Edward Collins _upleveled. So Edward does a fantastic job, and I wish I was better at social media and wish I did what he did. But on social media, he'll have people that will send him financial videos, tax questions, strategies, investment opportunities, loopholes, whatever you want to call it, credit building opportunities. And what he'll do is he'll do a side-by-side comparison. He'll watch the video, and then he'll tell you what is good or what is bad about that video. It's fantastic. There are other people in the financial professional space, Mark Kohler, Tom Wheelwright, Carlton Dennis, who I think they all do fantastic jobs. They're people who I think put out really good advice all the time. And they're people who you should look to for that advice. Again, like I said, I try and do a little bit of that. I could be better. But one of the things that we're going to talk a lot about real estate today. The reason we're going to talk a lot about real estate today is because there's a lot of hot topic. We're fourth quarter. Everyone's talking about tax planning. Everyone wants to figure out what they can do to reduce their tax liabilities. And there's a lot of hot button topics when it comes to real estate. Lots of these quote unquote loopholes that I want to make sure we discuss because there's fundamentally things that I think people are missing out on when they provide that clickbaity or financial porn information online. And even my clients will send me videos, even some of the Edward Collins Verified videos, and I've been featured on Edward Collins Verified. Or Uplevel, but they'll send me these Instagram messages, and and then I have to go into an explanation on, hey, this is going to work in your situation if you do X, Y, or Z, or this is why it's not going to work in your situation. And I think it's important that we discuss some of these things. The first thing that we are going to talk about briefly, I don't want to spend too much time in it, is wholesaling, fix and flipping. I've gotten a couple questions on that from some clients in the last little bit. We're in an economy where, in the right circumstance, fix and flip and wholesale can make sense in the right market, depending on what you're able to do with the property, depending on the quality of the property. I've got one client right now who he bought a multifamily unit in Idaho probably about 2 or 3 weeks ago. He bought it for $250,000, $300,000, give or take. He's going to put probably a couple $100,000 into the property, and then he's going to turn around and sell it, and he's still going to make a profit. I don't know that he's going to sell it. I think he's going to rent it. Yeah, that's his strategy, and it's a good strategy for him. But he still has the opportunity to make a lot of money on it. Last year, unfortunately, we have another client who does a lot of fix and flips and wholesales, and he kind of lost his shorts on some deals. His gross revenues weren't as high as they always typically are, due to some great tax planning strategies. Hats off to my team. He's actually getting a refund. We hopped on a call last week and he was really stressed about filing his tax return. I said, just calm down. Hey, you're getting a refund, couple $1,000, and he was like, oh, sweet. But with fix and flips, some of the misconceptions that I quite frequently hear are that it's taxed at capital gains tax rates, which might be true depending on the frequency and the participation that you have in the activity. Real estate is considered property. It's considered a capital asset. And if you buy real estate, okay, we're talking about from a fix and flip mentality, wholesale mentality, that transaction, you constitute a basis when you purchase the asset. And when you sell the asset, you constitute a sale of the asset, similar to like a stock. If you buy a stock on Monday, you sell it on Thursday, there's probably going to be a gain or a loss that you have to calculate based on what you sold it for and what you bought it for. Real estate traditionally is not any different. You buy a piece of real estate, you sell it on Thursday, there's probably going to be a capital gain or a capital loss based on how much you paid for the property, how much you sold it, and whether it appreciated or depreciated in value during that hold period. How long you hold that asset for is going to determine the tax consequence of that asset. If you hold it for less than 1 year, you are going to be paying a short-term capital gains tax, which is taxed at ordinary income tax rates. If you're in the 12%, 22%, 37% tax bracket, that's the tax rate at which you will be taxed on a short-term capital gains tax consequence or transaction. If you hold it for longer than a year, you are going to have to pay a long-term capital gains tax. And that tax is either 0, 15, or 20% based on what your total income is after you add in all of the incomes, including the gain from the real estate, to determine what your tax bracket is. Again, based on certain income thresholds, if your total income, stacked income, is less than 500 and some odd $1,000, you're 0% in taxes. If it's over that threshold, or excuse me, $0 to $80,000, you're 0%. 80 to like 500 and some odd $1,000, you're 15%. And then if your total stacked income is above that $500,000 number, you're going to pay a long-term capital gains tax rate of 20%. Okay. Now, what happened? I've got a client right now, and I'm going to use this as a situation. I've got a client right now that's gone through some education. They've paid for a course, a flipping course, and a wholesaling course, so that they can learn. It just so happens that this client, her husband, already owns like a handyman repair remodel company that he's been doing. So it's easy for them to supplement their income by buying a property. He can do all of the repairs at cost, and then they can turn around and they can sell the property for a profit. It makes a lot of sense. It's genius, absolutely genius. I've got another client who they're actually located here in Utah. They've started to do this the last little bit. They've gone and bought a couple properties. They've done a lot of the work, and now they're selling them for profits. For these clients, wholesaling and flipping does make a lot of sense. But in this situation, the idea is that we are going to participate in this activity with an intent to make a profit and be involved on a consistent basis and do more than maybe 1 or 2 deals a year. Okay. That changes the activity from being a capital to a business. When I change that participation, the frequency, and the intent, it changes it from a long-term or short-term capital gains to a business, which is now going to be taxed at ordinary income tax rates and subject to Social Security and Medicare taxes based on the participation that I have in the activity, which means I need to now set this activity up in an entirely different manner. The cost that I pay for the property is no longer a basis, it constitutes an expense, and it can become an inventory. And then what I sell the property for is a total revenue minus the cost of goods that it took me to purchase that property, the cost of that inventory, quote unquote. And it changes the tax consequence. Why is this important to know? Because now I have different tax consequences. I've got to take into consideration the additional 15.3% in Social Security and Medicare taxes because it's now a business activity. It's no longer a capital gains transaction. The biggest piece of advice here is now we've got to look at what is the entity structure that I'm participating in these activities with. For one of the clients specifically that I was talking about, they already have an S corporation because that's what the husband's handyman repair service business is, and appropriately so based on the revenues and net profits this individual has. But now we've got to supplement this flipping business based on the consistency and the participation that they are having in this activity to potentially have conversations about, well, now we need to constitute an LLC. Maybe we need to have that LLC be taxed on it as an S corporation based on how many we do in a year and what our net profits are in those flips. And again, wholesaling at that point too is it's inventories, it's transactions, it's business revenue. It's not short-term capital gains. If I have an intent to make a profit, if I'm materially participating in the activity, we'll talk about material participation in just a little bit. And if I'm doing it with an intent to make a profit, okay. I just think that's really important to highlight and understand because again, we're in an economy where people might start to want to fix or flip or do some wholesaling because they see X, Y, or Z person doing it on social media and making a profit. So that's important to know. And I will preface the majority of this conversation by saying, make sure you're talking with your tax advisor, making sure that they're on the same page with what it is that you're wanting to do, making sure that they understand the tax implications of what it is you're wanting to do. We do deal with a lot of real estate investors, entrepreneurs, business owners. And so we do fairly well understand what the tax consequences and implications are of real estate. I've got some cheat sheets pulled up next to me, but I hope I don't need to use too many of them. The next thing that I kind of want to dive into is this idea of a cost segregation analysis. We've talked about a cost segregation analysis on a previous episode of the show. Shout out to Nico Suazo and the Cost Seg Authority located here in Utah. They have done a phenomenal job with all of our clients that have wanted to get cost segregation analyses on the properties that they purchase. I'm in another Facebook group, and there was an individual, this was probably about 3 weeks ago now, another individual posted all of these amazing benefits and tax opportunities with the cost segregation analysis and what that cost seg has allowed him to do on his tax return and how it saved him, umpteen dollars in taxes and this, that, and the other. But I want to talk a little bit more about the cost segregation analysis as it relates to a real estate investor and how that real estate investor can utilize the cost segregation analysis effectively on their tax return. I also want to highlight when a cost segregation analysis probably doesn't make sense based on costs or participation or tax treatments of the investor. So briefly, for those who haven't gone back and listened to those other podcasts that we've done or doesn't know what a cost segregation analysis is, first, my recommendation would be to go listen to that podcast because we give some really good breakdowns and feedback on it. But briefly, a cost segregation analysis is a study done on a real estate property that allocates the many assets that are included in a rental property or a real estate property into its asset classes and lives as determined by the IRS. I feel like I could have done a better job explaining that. When you buy a piece of real estate, there's lots of assets in that one asset: flooring, electrical, appliances, roofing, footings and foundation, plumbing. The list can go on and on and on. Land repairs, different things like that, concretes. And the IRS has determined that all these different assets, whether we're talking about the plumbing, the electrical, the flooring, the roof, the footings and foundation, or we're talking about vehicles or, heaven forbid, horses, because you can depreciate horses. The IRS has said that all of these different assets have what they refer to as useful lives, meaning that it's the life expectancy of the asset. And you can recover the cost of those assets over what the IRS deems their useful life to be, in the anticipation that after that useful life is up, it's probably going to be time to repair or replace that asset and get a new deduction for the repair or the replacement. What's also important to note here is that in tax law, it's stated that if an asset has a shorter useful life than 20 years, a bonus depreciation can be utilized to capture more of a deduction sooner, rather than waiting the full extent of 5, 7, 15, 27 and a half, or 39 years. Why is this important to note? Well, again, that cost seg study is going to go, someone's going to go into that property and say, well, the flooring is worth X. The plumbing is worth Y. The roof is worth this. The appliances are worth that. And if we can capture a lot more of those deductions sooner, it's going to provide us with a much better tax opportunity now than waiting an extended period of time to capture the benefit of those deductions. Now, real estate, by technicality, is considered a passive activity. Okay. Your W-2 job, the business that you own and receive a wage or distributions from, the side hustle that you do, the woodworking shop, the consulting or the training that you do. Those are all active activities or ordinary income producing activities. And basically they define passive versus active as what is my material participation or what is the nature of the activity. Real estate's considered by nature a passive activity. Now, that being said, we have pigs and we have pals, okay? We have passive income generating services and we have passive activity losses. And passive activity losses typically can only offset passive income generators. There's certain passive activity loss rules that one is subject to. And really, those rules were set in place so that people did not have these major losses that just offset all of their income. Okay, now we got to remember the IRS has two objectives: raise revenue and incentivize activity. And they would defeat their first purpose if they just said, oh yeah, it doesn't matter what losses you have and what incomes you make, they can all just be jumbled together and offset each other. That's not really how it works. Capital losses offset capital gains. Passive losses offset passive incomes. Active losses can offset active incomes. But typically passive losses are somewhat restricted as to how much active income they can offset. Now, with real estate, it's important to understand that there are 3 different classifications that an investor can be classified as, and each of them have different tax consequences. The first way that a real estate investor could be classified as is a passive investor, okay? And all of these are going to involve different levels of material participation or how involved I am in the activity. Passive real estate investors are typically those who receive mailbox money. They put money into a syndication or a fund. They don't want any headache. They just want to say, hey, I'm going to give so-and-so some money. You're going to pay me out and just send me the money. I'm not going to worry about the property management. I'm not going to worry about putting tenants in the property. I don't want to worry about repairs and maintenance. I don't care what you rent it for. I just want some money. Okay, they really don't have any say as to what's going on in the property. This also might include a limited partner, like I said, in a partnership, whether that is a fund or a syndication or three buddies investing into a rental property. Now, the tax consequence is important to understand because if you are a passive real estate investor, that passive loss generated from real estate can only offset other passive incomes. Maybe incomes from another rental real estate property, maybe portfolio income or business income that you are a passive partner in. That's important to note because the tax consequences are important. Now, I'm going to take a pause here because I think it's extremely important to say, don't let the tax tail wag the dog. I see a lot of investors right now who are investing into real estate because, and we'll get into this in just a little bit, or they make decisions at the end of the year to spend X amount of money to help them save on certain taxes. Don't let the tax tail wag the dog. When you're making investments, make sure that you are going to get cash flow. Take into consideration appreciation opportunity. But taxes should maybe just be the cherry on the top. They shouldn't be the main course or the sundae that goes in the bowl. And so when we talk about these passive losses offsetting passive or active incomes, they have their tax consequences, but that's, again, only the cherry on top. Okay. The second way that a person could be classified when they invest into real estate is an active real estate investor. Now, at the very least, the majority of our clients are active real estate investors. We do have a few who just say, hey, I don't want to worry about it. Give me my mailbox money. Here's some money that's going to grow over time. Maybe they don't like the stock market or they're well diversified, whatever that might be. But for the majority, most of our real estate investing clients are active real estate investors. This denotes that they have some sort of participation in the activity. They have meetings about the properties. They might self-manage their properties. They depict or they decide what the rent is going to be. They maybe screen some of the tenants or find tenants for their rental properties. They might do some repairs and maintenance, whatever that might look like. In some degree, they're an active real estate investor. Now, the reason is because if you are an active real estate investor, you do have some opportunity to use the passive losses generated from real estate to offset other ordinary incomes like a W-2 or business income. However, you are capped, and if you start to make over $100,000 in an adjusted gross income, the total amount of passive losses, which is $25,000 that you can use to offset ordinary income, starts to phase out. And once you hit an adjusted gross income of $150,000, you're no longer allowed to use any more of these passive losses to offset active income. Okay. I'm going to take another little pause here. Why real estate? There's lots of statistics. And in fact, I read one the other day that says if you own real estate, you are 90% more likely to become a millionaire in your lifetime. And I've heard other people say, I've heard Chris Crone say this. I've heard Pace Morby say this. I've heard guys on Bigger Pockets say this. And I'm not denying it. I think it's very true. But real estate has made more millionaires than any other business venture or investment in the history of mankind. And I would probably have to agree with that. My dad always kind of said, if you have the opportunity to buy land or buy real estate, buy it because they're not making more of it. Not wrong. And that being said, from a tax perspective, real estate is one of, if not the only investment that an individual can make and potentially never pay a tax on it. How? When you own rental real estate, that word that we talked about before, depreciation, typically allows you to write off the cash flow or the income that you have from that property in any given year so that you don't have to pay taxes on it in the years that you're reporting the rental income. On paper, rental real estate should be a loss. There's a few situations where maybe it won't be, but typically rental real estate is a loss. When you go to sell your real estate, okay, what's the tax in the future? Real estate under current tax law allows you to exchange your used property for new property and kick the capital gains tax down the road. You receive a new basis or an adjusted basis in the property that you trade it for, as long as it's equal or greater value. You can trade straight across for one property. You can trade one property for multiple properties. You can even trade multiple properties for one property as long as it's equal or greater value. So I don't pay taxes now on the rental income. I don't pay taxes in the future when I dispose of the property, as long as I trade it. And if everything is set up correctly, what happens is my beneficiaries receive a step up in basis to fair market value at the time that I die and don't have to pay a tax on it when they receive it. Okay? I mean, that's a huge useful tool. That's why real estate, in my opinion, should be a part of everyone's financial or investment basket. Okay? I just think it's smart. That being said, we've talked about passive real estate investors. We've talked about active real estate investors. Let's get to the creme de la creme, real estate professional. And this is another one of those things that, in my opinion, is really clickbaity. There's a lot of financial porn. There's a lot of loopholes that are being talked about. But real estate professional is actually very cut and dry. Again, we have clients that qualify as real estate professional. Okay? We go through the tests. We make sure that they keep up to date on all of the requirements to be considered a real estate professional. And I would argue that the real estate professional status has saved our clients more money than potentially any other tax strategy that the Internal Revenue Code offers. Okay? It's very good, but because it's so good, you need to make sure that you do qualify for it legally. Now, before I dive into what or how to become a real estate professional, I do want to talk about the tax consequences. Being able to be considered a real estate professional allows you to use any and all of these passive losses that would qualify under the real estate professional status to help offset any and all of your ordinary or passive income. What does this mean? If, for example, my wife is considered a passive, or excuse me, if she's considered a real estate professional and we go buy a rental property and we perform a cost segregation study on that rental property and we have $500,000 in business and W-2 income, but we go buy a rental property and have $400,000 in depreciation expenses for year one based on bonus depreciation, we now only pay taxes on $100,000. Okay. You're in a 20% tax bracket, just for all intents and purposes. On $500,000, that's $100,000 in federal taxes. On $100,000, I'm now paying maybe 20. Okay. I mean, there's huge opportunity as a real estate professional. But admittedly, not everyone qualifies for it. There's a couple rules that one has to meet, or tests that one has to meet in order to qualify as a real estate professional. The first test that one must meet is that more than 50% of the services that you perform in the year have to be in real property. What does that mean? Lots of different, opinions and opportunities. That could be anything from managing properties to selling real estate to construction to title and lending to just the participation in your rental activities. There's lots of opportunities in real property. Now, the other thing I will mention is if maybe you are a mortgage lender, work for a bank, okay? You would not be able to qualify unless, as an employee of the company that you worked for in real property, you owned at least 5%. Okay. Where this potentially could work, that I've seen it work, is a real estate agent who sells real estate, owns their own business, and is a more than 5% owner of that business. They still work in real property, but they're a W-2 employee of their own business. Okay. Just saying that's a scenario that could work. So more than 50% of my services have to be in real property that I perform during the year. The second test is that I have to perform, or I have to participate in the rental activities at least 750 hours a year. Okay. which denotes there's a little bit of work that's involved in my rental activities. What is that? What are those hours comprised of? What does that mean? Again, lots of opportunity here. I could be decorating properties. I could be advertising properties. I could be meeting with my financial team about my properties. I could be reviewing P&Ls about my properties. I could be screening tenants for my properties. I could be doing repairs on the properties. There's lots of opportunities. How many hours is 750 hours? To kind of break that down for you on a 52-hour work week, you're looking at about 10 to 14 hours a week. Okay. Is it a lot? I would argue that it's probably more than a lot of people want to spend in their rental properties. But again, the tax benefit is so great that maybe I do spend a couple hours. Maybe I do kind of stretch myself and find opportunities to invest in more real estate. The third kind of unspoken or unforgotten rule is that, again, if I am in a situation where maybe I do hire a property management company, there are material participation requirements that I still have to meet, and typically there's 7 different tests. Okay, and we'll get into this on the next hot topic that I might rant on. I'll apologize in advance, but there's like 7 different tests that qualify one for material participation. That anyone might run through in determining whether or not they could qualify as a real estate professional. Typically, the one that's used most in the scenario that I gave, where maybe I do perform more than 50% of the services that I perform in a year in real property, and I do work 750 hours a year in it. The other one is, okay, maybe if I've got a property management company, I just have to work 100 hours more than that property management company in my property or properties. Okay. Passive, active real estate professional, qualifications of what it is to become a real estate professional. The other thing I'll just say really briefly, I've talked about it in other podcasts that I've been featured on. We've talked a little bit about it in this podcast, but real estate is an activity that should be performed in an LLC. Okay. We don't like rental real estate in corporations. There's some tax consequences that could potentially arise when we have or transact real estate in corporations, whether that's an S or a C corporation. Rental activity, real estate, those are holdings that should be done in an LLC. I'm not so much worried about the tax consequence. We discuss liability consequences when it comes to real estate, which is a conversation that we bring an attorney in to help you understand how it fits into your situation. But just that one little note. Okay. Now we're getting into the last bit. Okay. So I mentioned Edward Collins _upleveled, a fantastic Instagram account. I made a comment yesterday on one of his posts. We'll see how it fares, but I'm honestly a little sick and tired of the clickbaity financial porn information on short-term rentals and the quote unquote loophole that short-term rentals provides individuals. And I want to dive into this just a little bit. I hope I don't take too much time. We'll see. Everyone is really talking about the opportunity that short-term rentals provides to kind of bypass those passive activity loss rules that I talked about just barely when talking about active, passive, and real estate professional, real estate investors. And if you are on a W-2, you can write off all of your W-2 income if you go buy a short-term rental property. Now, I want to get into the technicality really quick before I dive into the tax opportunity. Please note that to me, a loophole means an unintended tax consequence. So there's something there that is probably a little bit more black than it is white. I would consider the ERC credit one of these loopholes that I think a lot of people took advantage of. We've now seen that the IRS has put that on their dirty dozen. I think it was legit, but just a lot of people took advantage of it in ways that it was not intended to be taken advantage of. This short-term rental loophole, I'll call it an opportunity because it does present a great opportunity for those that are able to do it. It needs to be explained from a technicality standpoint, because I think a lot of promoters online are just saying, hey, go buy a short-term rental property, classify it as a short-term rental property, put it on Airbnb, VRBO, and you'll be able to do a cost segregation analysis on this property, get a bunch of bonus depreciation, and utilize that bonus depreciation to offset your W-2 or your business income, even if you might not qualify as a real estate professional. Now, please note that there's a couple technicalities here that need to be put in place. Short-term rental real estate can be utilized to help bypass passive activity loss rules if you do not qualify as a real estate professional under the following circumstances. One, the average length of stay for my renters has to be less than 7 days. Okay, you can calculate that by taking the amount of trips that you've had and the amount of days that they were on those trips to get the average of less than 7 days. Okay, not really hard to calculate that and keep track of that. A platform like Airbnb would be able to tell you that pretty quick. The second test, okay, or the second requirement is that I have to provide substantial services in my short-term activity. Okay, now this is where people need to understand a couple things. There are no revenue rulings, court cases, regulations. There's not a lot of information, if any information, from the IRS about what qualifies as a substantial service. I have seen opinions. I have seen technical letters that qualify as substantial service as maybe any one of the following. I'm providing transportation to and from the Airbnb. I'm providing a quote unquote bed and breakfast opportunity where maybe I do cleaning services daily rather than just the day they check out. Maybe I'm providing touring services for the people that are staying at the Airbnb. Maybe I'm providing meal services, whether that's a breakfast, lunch, or dinner service for the individuals. I've seen some opinions on maybe including additional amenities or upgrades and catering to those amenities or upgrades. I basically have to go a little bit above and beyond advertising my Airbnb online, giving them instructions when they check in, giving them instructions when they check out, and then going to clean the property when they check out. I think that's what people miss a lot on. Now, the next thing I will say is that not only do we have, the average length of stay and then these substantial services, we also have that idea of material participation that we've talked about before. Again, I think there's some I've seen promoters of this opportunity who say, hey, go buy an Airbnb and then hire a management company to provide those substantial services for you. And that's not true. That disqualifies you. That continues to make the activity a passive activity, and you're still subject to passive activity loss rules. This activity has to become an active activity. You have to have material participation in this activity, meaning I've got to spend at least 500 hours a year in this activity. And if someone else is doing it for me, I have to spend 100 hours more than that individual or that entity in my rental activities. There's 7 tests of material participation here. Maybe this activity has to be a significant participation activity in the taxable year. Maybe it constitutes that all of the participation in that activity is done by me. Maybe it's done on maybe this activity is done on a regular, continuous, and substantial basis. The activity might be my personal service activity for any of the 3 taxable years preceding this taxable year. So again, it kind of comes down to this material participation. Now, some clients that I've talked to recently who have brought this up or sent me videos on Instagram or TikTok or whatever about this, when we get into it and dive into the weeds, say, okay, well, if you're going to want, here's the tax opportunity, but here but you've got to also do X, Y, and Z in order to qualify for this. They get all of a sudden kind of turned down. It's like, well, I just wanted this to be a little bit more passive. Okay, that's great. We're going to cash flow. We're going to make some money, but here's a tax consequence if it is a passive activity. And they just need to be a little bit more mindful of that. Now, technicality wise, and here's one thing that I also do want to highlight. When it comes to this short-term tax rental opportunity, it changes the taxation. Really what I'm saying is because of this material participation It's no longer a passive activity. The income is actually subject to Social Security and Medicare tax in this case. What does that mean? Well, we change how we report this information to the IRS. And at this point, not only do we get to potentially take all this bonus depreciation and utilize that bonus depreciation to offset all of these other incomes that I may or may not have, it changes the tax consequence. And I've seen a couple people, this is just my 2 cents, this is my professional opinion. Consult with your personal advisor. If you don't have one, reach out. But a lot of people have been reporting these transactions and these activities on a Schedule C of the personal tax return. Historically, Schedule Cs have always been the highest audited form from the IRS. I don't like Schedule Cs. And where the opportunity presents itself, I want to move away from that Schedule C. So if it were me, this is, again, my recommendation. If you were to qualify under the rules and tests that we've talked about today for this short-term rental opportunity, my recommendation is get it off of Schedule C. Again, I don't like corporations and real estate. They do not mix for several different reasons. Utilize an LLC, maybe even an LLC tax as a partnership with partners if it's you and your spouse. If it's not, file it on Schedule C. Make sure you have the LLC implemented there for the asset protection. But utilize that partnership tax return to get it off of Schedule C, report it on page 1 of the partnership tax return so that we reduce audit risk on your personal tax return. I think that's really important in a lot of things that some advisors don't really think about when they're participating in these activities. That's my rant. That I'm done with my rant. But that being said, there are some really great opportunities in real estate. Cost segregations are a great opportunity. If you can't utilize them effectively as a real estate professional, they may not make sense. Run the numbers, but I haven't ran too many numbers where it does make sense. Funny enough, we ran one this past year for someone who is not a real estate professional, and it still made sense based on other passive activity income that she had. It was just one of those wonky situations. Talk with your advisor. Make sure you understand not just what it is, but how it's done, the technicality behind it. What's the opportunity? I want to highlight one little experience that I had about a year ago. I was it was a pretty intimate group setting training. There was maybe 12, 15 of us in this group that was going through some economy training with Robert Kiyosaki. It was very interesting. Robert Kiyosaki is a very intellectual individual. And the question was asked, a lot of my clients are really worried about investing in this. Again, this was about a year ago. This is when the feds were starting to raise interest rates. We started to go from a 3 into a 4, 5, and 6 interest rate. Now we're into 7 and 8s. This other advisor asked Robert Kiyosaki, a lot of my clients are worried about investing into real estate because of the interest rate. And Robert Kiyosaki, he's a very blunt individual, basically said, if your clients are worried about an interest rate, they shouldn't be investing into real estate. And I had to mute myself because I was laughing, but it's true. If you're so worried about an interest rate, you're worried about what that's going to do to the amount of money you're going to have to pay a lender. If the only thing you're focusing on is the tax consequence of the deal you're doing, you're missing the point. Don't let the tax tail wag the dog. Don't let the Fed's increasing interest rates scare you from getting into real estate. Our tax law has been really good the last couple of years, and we're starting to phase out of some bonus depreciation that has our interest rates, and our tax law has made investors really stupid, to be honest with you. And it's going to require you to be a little bit more creative. It's going to require you to run your numbers, make sure that you are going to cash flow on your properties, no matter what the interest rate or the tax consequences are. Maybe not depend on, appreciation so much. I'm victim, I'm guilty of that. We bought some real estate, sold it, not, a year later. It was actually just right on the year mark. And we made a ton of money just in equity. Our cash flow was pretty low, but we knew it was an equity play. But run your numbers, take the calculated risks, understand the technicalities on the back end, because the more informed of a decision you make, the less risk you take out of that deal and the more opportunity that it presents itself in the long run. I hope, again, like I said, end of my rant. I hope that was helpful. I hope we did get a little technical on some things. If you have questions, please reach out. You can find me on Instagram at the Brady Slack. You can respond to us, leave some show notes. If you have questions, please, please comment. Tell us what you liked. Tell us what you didn't like, so that we can continually improve for your benefit. If you would like a consultation, go to my Instagram. There's a link in my bio. We're happy to provide that consultation for you. I want you to succeed. I want you to make more money. I want you to pay less dollars to the government. I do want to help you make more money and pay less in taxes. But all things real estate. Real estate's a great investment. Our economy's a little wompy right now, but that doesn't mean that there's not good deals out there. And then just make sure you understand the tax consequence, especially as we head, we're in Q4. We're kind of getting into the thick of things. People are going to start to say, hey, what can I do to reduce my tax bill? There are things we can do to reduce your tax bill. We can still buy some real estate before the end of the year. You can still place it into service. You could probably still qualify under material participation rules for that activity, but we want to make sure that you do it the right way. I hope this episode was helpful. I appreciate you for listening. And have a great day slacking off.
Thanks for tuning in to Slackin' Off with Brady Slack.